Hi everybody, welcome to today's webinar, and thanks so much for taking the time to tune in to this webinar. I know from the video that you clicked on to register for this webinar probably got your attention. You're thinking, what is this all about? I'm not going to let you down. You're going to, I think, be blown away by what you're about to see and hear. So be prepared. If you need to take notes, grab a piece of paper and a pen, and you can write down some questions. Feel welcome to send the questions to me. If you're going to put some questions in the chat box during the webinar, I'll try to get to them, but rest assured, be sure that I will be reaching out to everyone with answers to your questions. Today is going to take about a half an hour to explain this strategy. It's not for everybody, but for the people that actually qualify to use it and are in a position in their life, so not all strategies are always just universally great for everybody. It depends on where you are in your life and the ability to actually fund certain solutions or strategies. So today is going to talk about one particular strategy on how to actually use your money in a different way, where you can deposit money to a product where the growth of it is tax sheltered, and then allows you to collateralize the actual cash that you're saving and use that collateralization any way you like in your life, whether it's through your business or through you personally. This is going to be something truly amazing. So let's dig into this right now, and I look forward to your reaction. If you're new to seeing me online, my name is David Aaron. I'm an advisor working with business owners, individuals, and families right across Canada. I've been doing this kind of work for just over 20 years now. And when I say what kind of work, well, I'm an advisor, so I actually manage my clients' money and I do their insurance. If you're a business client, it's likely I might have your group benefits plan, but I also create your financial plan. I think it's really important to work with one individual that knows you very well, creates the plan, updates the plan, and is with you throughout your time, pre-retirement and through retirement, making sure that the plan that we're putting in place, we're making adjustments, we're updating it. If anything changes in your life, we're updating that plan, and we're making sure that you're successful leading up to retirement and then having an awesome retirement, not worrying about your money, but just worrying about what are you going to do with your time and how you're going to enjoy your life. So with that said, let's dig into why you're here today. And I look forward to your questions. Again, just put any comments you have in the chat box and I'll get to them as we go through this. Generally speaking, when I do planning for people, we say, well, if you're going to need more money, that's going to increase your tax base. And I don't want to say that people are not, they don't care or they're cavalier about, oh, so I have to pay more taxes. I don't care. I'm going to have these experiences. People are very much aware of wanting to not pay more money to Revenue Canada. So if that is the case, wouldn't it make sense for you to try to, or at least consider, an investment opportunity or an investment strategy that gave very little or no money to Revenue Canada and then left money at the end of your life of having enough money to do all these things, would still have enough money to give to your children or your grandchildren or your charities? Doesn't it make sense that if you're thinking about that, about minimizing the tax going to Revenue Canada, that you would invest in a solution that does that? That's what we're going to get into today. You're going to love it. I hope you love it, because it's one of the things that I love talking about, because the reactions from people when I deliver this information is they're in disbelief that no one has ever explained it this way to them. So I hope you enjoy what you're about to see. Okay, you might be, let me frame this, okay? Who might this information might be useful for? You might be a couple whose kids have finally moved out. They came back from university to live with you for a little while, and now they've gone and they're on their way. They have their own families, and you're stuck with this 4 or 5 bedroom home, and you say, you know what, we don't need that. Let's downsize, and you move to a condo or to just a smaller, maybe a 2-bedroom home, and you have now $1 or $2 million in a non-registered account that you pay tax on every year on the growth of that investment. So what you're really looking for is a solution on how to invest your money in a tax efficient way, and then also maximizing your estate, right? Those are usually the two things that kind of couple are looking for. Or you might be a business owner, an incorporated business owner. You're doing well for yourself. You've invested your money inside of your corporation. You may have not done a lot of discussion around corporate structure. And in doing so, you've got this, and also if you've invested your money for about a decade now, that money has ballooned up to a point where you've got this huge accrued tax problem, and the moment you try to take money from it, you're going to have to pay the tax bill. So what do? You just leave it alone. You think, forget it, I'll deal with it later, and it just becomes a bigger and bigger problem for you. And also in having too much money in your corporation without getting, I don't want to go sideways, I want to stick to what we're talking about today. Go on my YouTube channel, you'll see all kinds of videos about, capital gains, or the lifetime capital gains exemption that having too much money in your corporation would make you ineligible for. So a business owner has a particularly different problem. The passive income tax rule of 54% tax on just investing at GIC, and you're going to pay 54% tax. That's a problem. So again, this solution applies to a business owner. You might be a real estate developer or just a real estate investor. Maybe you just have one condo that you rent out, or a couple Airbnbs. Maybe you've got 100 rental properties. And the problem is not so much the income that you're receiving each year, but it's the accrued tax liability, right? All those properties have gone up in value. And so the question is what is your solution for paying off the tax that is on these properties? Certainly the biggest problem that we have is at death. When we die, we don't pick the day that we die. And so if you knew that in advance, then you could plan the investment strategies around that. But because we don't, we often die with assets that are subject to taxation by Revenue Canada. So what's your plan for paying off the tax on those properties? Please don't tell me the plan is that you're going to allow your executor to pay or just sell one or two of those properties that you saved for and worked hard to acquire, that they're just going to simply sell one to pay Revenue Canada so the rest of the properties can come over tax-free. That would be disappointing because there's an easier solution. Okay, so let's get into how we're going to do that. And by the way, if you are a real estate investor and you're putting your own money into these deals, well, this simple strategy is going to help you to actually do the same thing you're doing already, just in a different way. So this is going to be really important to you. Okay, let me ask you a question. And you can put your comments in the chat. I'd love to hear what you have to say. But let me ask you this question. Who will benefit the most from your assets? Now, obviously, while you're living, your children, your spouse, even grandchildren are benefiting from what you're doing today, right? But when you pass away, who benefits from the actual assets that you have? Let me take you through a little illustration here. Think about this. May God bless you with many, many years. But if you've passed away and in the room when the lawyer is reading the last will and testament of you, they are going to say, okay, here's what the estate is worth, and here's how it's been divided up according to the will of this person. Certainly, I would think if you have children, you want your children, even your grandchildren, to be the biggest beneficiary of your estate. Does that make sense? I think it does for many of my clients who have children. They want their children to have the lion's share. The other person is actually your accountant or your executor. Somebody who is the executor of the estate is entitled to about 5% of your estate. That's not such a big problem, 5%, right? But you do want the rest of the money going to your kids or your grandchildren. But actually, it's Revenue Canada. Revenue Canada is sitting there at the end of our days waiting for all of your assets that are going to be in your estate to be taxed. There's probate in Ontario. There's probate across Canada. Alberta has, I think, probably the best probate in terms of is very little at all. But then there's also taxes on your estate. So you rental or you real estate investors, you've got all these properties. You got to figure out what to do, whether you've put them in a trust or whether they're partly owned by you and partly owned by your corporation. And again, that's a mess too, and how it's done corporate structure. But the issue is that Revenue Canada is waiting to take your money. In fact, if I was to just say to you that all three of those individuals, the couple that sold their houses or their house and has a large non-registered account, the business owner who has money in the corporation and maybe some other mixed assets like rental properties, and the real estate developer, they have this same problem. The tax problem is the biggest thing. So it's not just about when you approach an advisor like myself and you say, what's the best return I can get based on risk? I mean, that is important, but the bigger thing is the taxes that you're paying. This is the single most overlooked item, I think, when you're just starting out. Most people are just thinking about putting money into an investment. The real issue is about who's there waiting to take part of it away from you, okay? So let's look at all the ways, well, not all the ways, but a number of ways that you might be investing today. You might have a stock portfolio, you have a business, you have a real estate portfolio, and you have savings. All of those strategies, we'll just say we want them all to appreciate. And when they appreciate in value, they have a tax liability. And that tax treatment is different for each one of those types of ventures or accounts, right? Some of those accounts attract 54% tax, as in the case of a passive income tax rule for a business owner, while other accounts attract either zero tax or very little tax. So one of the things that you want to consider when you're planning for your retirement is what accounts are you investing in, and what are the other alternatives that you could invest in that get you to the same destination but result in either having more money or paying less tax. Does that make sense? Okay, let's move on. Okay, so let's look at now a non-registered account where you would see that in that couple that has that sold their house downsized. Or maybe this is a business owner, you're a business owner, you've got money in your corporate account. You can notice the green line, that is your pre-tax growth of your investment. And the red line is the after-tax growth. So after you've paid all your taxes, what you have left. I think most people are fairly familiar with the fact that their balance is not their real balance. They have for the tax liability that they have to pay. And the issue with a business owner, as I've said before, is the passive income tax rule of 54% on the money in your corporation that you are not using to build your corporation, to grow your corporation. This is the money that is above and beyond that area. That's the amount of money that Revenue Canada is going to say, look, you're not using this to grow your business, so we want you to grow your business. We want you to hire more people. We want you to expand, and we're not going to tax you too heavily on the money that you're saving, let's say in a GIC that you're going to plan to build a bigger, let's say a warehouse, whatever. We're going to tax you heavily on the money that you're just investing in your corporation because you want it for later on for retirement. We're going to tax all that at 54%. It's a disincentive for you as a business owner to do that. So there's another alternative, which I'm going to get into. Plus, if you want to pull that money out of your corporation and hand it to you personally, again, it's a tax problem, right? If you look at RIF accounts, this is your RSP converting to a RIF when you go to retire. The graph is completely different. Revenue Canada wants you to expire that account down to zero before you die. In fact, the highest withdrawal rate is 20% when you're in your 90s. They want you to not die with money. But sadly, most people die with an RSP or RIF balance because, again, we don't choose the day we're going to die. And so we think, well, let's plan for 95 or 100. But the average death in Canada is 86, 84, depending on you're a male or female. And so that's like a problem, right? People die before they expected, and there's all this money in a RIF account. And what happens on the last death of a RIF account, meaning it rolls over to your spouse, what happens is about half of that, not quite half, but pretty close. It's fairly dramatic. Look at that green line and look at the red line. It's a lot of money that goes to taxes. Now, if you're with an advisor that does financial plans, creates a financial plan, inside of a few minutes, they can tell you what the expected amount of money that your estate would lose to Revenue Canada in a financial plan. So that's one of the things that I highlight for all my clients, saying, look, when you pass away in any given year, here's the amount of money we're going to lose to Revenue Canada. How do you feel about that? Do you want to do something to address that? It's up to you, but we make you aware that here's the hundreds of thousands of dollars, in fact, sometimes millions of dollars, that you're going to lose to Revenue Canada if you don't put some kind of solution in place. What you really need is a withdrawal strategy. This is the whole thing. So one of the things I alluded to earlier before is that people spend, in the first third of their adult life, you spend a lot of time depositing money and contributing to different retirement accounts, whether it's an RSP, a tax-free savings account, a non-registered account. You spend a lot of time doing reviews, trying to get the best rate of return. How much more money do I put in it this year? January, February rolls around, it's RSP season. You say, well, if I deposit this amount, I'll get that amount back and I can use that money whatever way, instead of thinking about how to use it in your financial plan to retire with more money. There's all these things that are going on, but very few people actually say, well, if I keep doing this, I'm going to end up with this amount of money, an income stream when I'm whatever age, if it's 65 or 62 or 70, whatever age, you're going to start taking money out of your accounts. Very few people spend time saying, if I keep doing these things, this is what I'm going to have. And here's how much tax I'm going to pay each year when I'm retired. They just kind of singularly focus on, let's get that money into the account. And so what you really need to be focused on is, what is your withdrawal strategy? Not just about what is the accounts, that the sequence you're going to take money out of, but what kind of solution could you be investing in today that's going to give you a better withdrawal strategy? That's what we're going to really look at today. Okay, now if you look at this, this is a graph. We're getting now into what we're about to talk about. This is a bar chart. This is talking about cash value life insurance, participating whole life insurance. This is the one thing that is going to make you rethink life insurance, okay? I'm showing you a decade of growth. Now, you would look at this chart and say, well, David, if all my investments look like this, I would just invest in something like this. And I hope you're thinking that, because that's what life insurance, participating life insurance looks like. You can see that each year, the cash value went higher and higher and higher, higher than the previous year. That's the way participating life insurance works. The cash value does not go lower. Now, if you have ever looked at this and you're saying that's not true, it does go lower, then you might be invested in universal life insurance, and it does something completely different. The value of your balance of your cash depends on how you've invested your own money. Think of it like a defined contribution with your employer, where you put money, they match it, but you decide where you're going to invest the money. Some years it's going to be negative, some years it's going to be positive. But if you're in a participating life insurance policy, the insurance company gives you a dividend each year that gets added to your cash that you've deposited, and that grows, compounds on itself. So there's no more of this fluctuation. This is what I want to make the difference is. This is very important that when we're talking about this strategy, we're talking about this kind of insurance, okay? I'm going to now superimpose the Toronto stock market, last 10 years of volatility, and you can see here, this is the actual volatility from 2012 to 2022. And what do you notice about this? That from 2012 to 2022, yes, the market went up. But the key here is that when you go to withdraw your money for retirement, it may be a very inconvenient time for you to take money out of your portfolio, given the fact that the market is collapsing underneath you. Look at 2020, 2022. If you go all the way back to 2008, you remember what that looked like. It took 5 years for that money to recover. And here we see 2016, 2018, 2020, 2022. So it's not a singular phenomenon. This is happening all the time. There's going to be this volatility in the last 10 years, and there's going to be volatility like that for the next 100 years. So what I'm proposing is that you think about in your investment strategy to use something that doesn't or is not susceptible to this kind of volatility, so that you can have year over year compound growth of your money. And when you have that kind of consistency, you're able to plan better, knowing how much money you're going to have in a given future. It's just more predictable. I don't want to say it's 100% predictable. I'm just saying that it's more predictable. In the 20 plus years of doing this, we're able to actually see, what did we illustrate at, and where is this amount of money going to be? We can have a good predictive nature to what your cash value looks like, in addition to all the other things you get with life insurance. So the other thing that I love about life insurance is that you get paid to own it. Now, when you are thinking about an investment strategy, the investment strategy, like in the stock market, it depends on how well the stock market performed, and you would get, whether it's a capital gain, interest income, or dividends coming into your portfolio, but it's not always guaranteed. There's not always, there are going to be years where you're disappointed, right? Although with life insurance, For like 150 years, the insurance companies have paid a dividend every year into the insurance policies. So there's some consistency there that you can fall back on. It's a little bit more reassuring to see what is the history of an investment over the past 150 years in terms of receiving a dividend compared to the stock market, right? Now, we're going to not go into in depth all the things about a life insurance policy. What we're really going to talk about is one particular strategy. Even though that this strategy is called an IRP, you can see all the other awesome benefits. Infinite banking is very much linked to IRP. Insurance has tax-free income. It's a tax shelter. It has a tax-free death benefit. Of course, there's cash value there. It's the principal tool used for estate planning. And it's also considered a fixed income alternative because the dividend, the annual dividend that you get from the insurance company is very much in terms of a return, very similar to your fixed income portfolio. The only difference is you're not paying tax on the growth when it's inside of your life insurance policy. So that kind of leads us to, what does that mean? So I'm going to share with you just some examples here, comparing what I think the two most traditional products for investing are, and the other two products that you could be invested in, and let's just see what it looks like. You, of course, are used to an RRSP, Registered Retirement Savings Plan. You can deposit 18% of your earned income of the previous year up to a maximum of each year. There's a limit. For 2023, $30,000, $780. So it's a pretty decent product for you to invest your money in. It may be the only one that you can use because of your circumstances, and so you're putting money forward for your retirement, okay? That's fine. A tax-free savings account, again, another great product, started many years ago. You can put now, for 2023, they've increased the limit to $6,500. So, but there is an annual limit that you can deposit to a tax-free savings account. The IPP, Individual Pension Plan, means you have to be an incorporated business owner. There's all kinds of, well, not all kinds, there's several hoops that you have to go through to qualify for this, but the result is if you can get an IPP for you in your business, this is the Cadillac of saving for retirement. You can see there that if you're age 50, around about $345,000 is the amount that you could deposit into that account. We're talking about a more complicated investment strategy, but it's basically creating a pension plan for yourself. But the thing with an IRP, this is called an Insured Retirement Program. This is you being able to deposit. There's no maximum amount of money, provided that you are in a position to actually have enough money to do that. Your maximum is basically what is your affordability to deposit the amount of money. So there is no real maximum. And if you consider that, if that's the case, these three accounts had limitations or caps, if you will, whereas using the life insurance, there's no cap. How much money can you afford actually to deposit each year into insurance is your cap. And that's what I love about it, because it's saying to the person who's saving money, I have more money I can put into this. How much can I put in? Let's talk about that, and what does it produce at the end? Now, I'm going to lead you now. Some people think visually. So I've got two different ways to show you today. One is I'm going to show you a diagram here, and I'm going to lead you through the strategy. And the second is I'm going to show you the math. For all you people that like to see, give me the data. I'm going to show you the math, and you're going to see both ways. And when you look at this at the end of the day, you're going to say, why has no one ever showed me this? This is crazy. It doesn't seem fair that I've only been doing one way. And the reason is because you have to have a life insurance license in order to talk about this. If you're dealing with an account manager at your bank, likely they're not having an insurance license, and so they're just going to talk to you about the bank's mutual fund, and talk to you about RSPs, TFSAs, and by the way, do you have a credit card? Would you like one? My business model is different. I'm an advisor. My job is to grow and protect your assets by using different types of investment solutions, following a financial plan, and I'm not trying to get you a credit card. I'm trying to find you the best possible solution that fits your risk tolerance and timelines. Okay, let's look at the traditional investment on the left side versus participating life insurance, dollar for dollar, comparing apples to apples, okay? You're going to invest $1,000, as an example, you're going to invest $1,000 per month for 20 years. Now, you do not have to invest for 20 years in life insurance. The minimum timeline is usually 7 years, but you could invest for 8 years, 10 years, 15 years, 20 years, right up until the day you die, you could be investing in insurance. It's up to you how you structure that. But let's just go for the purposes of comparing apples to apples. Let's just do a 20-year term, okay? So you've got 20 years of depositing $1,000 a month. That's $240,000 deposited into a non-registered investment. Let's say it's a balanced portfolio, okay? What do you experience in a non-registered portfolio is that you have to pay tax on the growth of your investment. So that means that that's the tax grind that's pulling back from your ability to have a higher balance, as you got to pay some money to Revenue Canada. Now, you get to a retirement age and you say, I would like to take money out of this portfolio to supplement my lifestyle. And I want that to last, let's say, a 15-year period. Think about somebody who might be like 65 years old or 70 years old. Say, give me an equal amount of money each year that's going to last me for 15 years. What is that number? Well, that comes out to $490,000 over a period of 15 years. And then let's say the person is, 85, 86 years old, the mortality rate in Canada. Person dies, and they've died expiring all the money in their portfolio. They have $0 there, but they enjoyed the money, right? But they have nothing left to give to their beneficiaries. Okay, now let's contrast that or compare it to using participating life insurance. Same amount of money, $1,000 a month for 20 years is $240,000. But when it's deposited inside of a life insurance policy, you don't have any tax on the growth of your investment. So similar to the way you might experience looking at your tax-free savings account or your RSP, it's not an RSP deduction, okay? Just the idea of this, the way that you're not taxed on the growth of your money, same thing happens in the life insurance policy. And I can see all the bells going off in people's head, a business owner going, wait, I can put money that I'm being taxed 54% on in my corporation. I can start to push that into life insurance. Remember, it's not an expense. You're just putting it in a different account. Instead of an RSP, TFSA, corporate account, those are all kinds of different accounts. Now you've got the insurance option. So you can just say, okay, I'll just transfer that money into the insurance policy. And now the growth I don't get taxed on, and you don't have to report the actual growth to Revenue Canada. That starts to get a little bit exciting, right? So now, because you're not paying tax on the growth, you end up having more money to use in retirement. In this case, we'll call it $550,000. Now, what is the principal difference? If you read that there, these are the cumulative tax-free loan advances. You are going to collateralize the cash. Collateralize means you're just going to pledge it as an asset for a loan from the bank. Completely different now. You had, in the left side, you had cash in a fund that was subject to volatility and subject to taxation. And now you've got cash inside of a life insurance that has very little volatility, very little risk, and it's actually cash. So instead of you taking the money out, like withdrawing the money out of your insurance policy, you pledge it as an asset, the same as a real estate investor, right? Think about a real estate investor, their house is going up in value, the people are paying down the mortgage, there's your equity, you collateralize that equity, and you either put it in your pocket, tax-free income, or you go out and buy another property with it. This is your other house. The cash value is growing in the life insurance policy, you take it to the bank, here's the cash, collateralize it. So now, in this example, we're going to treat it the same way as the one on the left. We're going to just say to the bank, I want to receive an income every year. You could have gone and taken 90% of all that money right away, but you just say, I just want to treat it like an income stream. So you get $550,000 over the 15-year period. Then you pass away, same as the other side of the page. But $1.3 million goes to your beneficiaries tax-free. Now just wait. Wait for your reaction, because you just got to think, why would I be doing this strategy on the left when I could have had this strategy on the right? So this is the difference of working with an advisor who is able to speak on multiple strategies because they're licensed to do so, as opposed to working with someone who is it's convenient, it's at the bank, I can quickly talk. Don't want to bash people, but the bank serves a purpose. They're there to collect your money and offer you products like mortgages and GICs and credit cards and lines of credit. They're a lender. And if you want to participate in giving them money, they're also going to want you to borrow money, right? So they're not specifically designed. A bank, they're prohibited by law to talk to you about life insurance in the branch. You have to go to a different location. So this is why working with an advisor that might be multi-licensed, especially life insurance, you're able now to say, give me a wider view of what are the available types of investments I could use to invest for my retirement. So pretty wild. I know you're wondering what is going on. It's blowing your mind. If it is, I want to see your comments in the chat, because I just want to see what you're saying, and I want other people to say what is going on. How come I've never been shown this? Okay, now let's help the people that also want to see the data. And I'm going to go through this quick. I don't want everybody to be bored, but it looks like a lot, but it's not. I'm just going to show you that on the left side is your life insurance policy, and on the right side is how you receive the money, okay? And for the moment, I'm just going to blur out the right side so we can focus our attention on the left side. Life Insurance 101. There are three things in life insurance. There's the money that you put in. That's the green box. That's called your premium, or we'll call it deposit. In this case, I'm showing you $100,000. Why? Because if you're going to do this kind of strategy, especially if you're a couple who've sold their house sitting on $1 million or $2 million, then you're not putting $1,000 a month in. If you're a business owner and you're doing well and you're getting close to retirement, you've ballooned up your investment account, you've got plenty of cash, again, not putting $1,000 a month in. And if you are a real estate investor with several properties and accrued liability, you don't need a $50,000 death benefit. You need a much larger death benefit. And also, I've just pointed out to you that you can collateralize the cash value to go ahead and buy another property with it. So you might be thinking, I'm going to want to have $200,000, $300,000, $400,000, $500,000 in cash available at any given moment so that I can go to the bank and buy another property. So let's look at this together. $100,000 a year. We're going to use this as an example. If $100,000 sounds too much, then cut this in half, cut all the values in half, and just think about $50,000, okay? So $100,000, the minimum length of time is roughly 7 years, and it depends on the age of the person and so on, okay? But let's just say 7 years. So you've put in 7 years of deposits. You also get the cash value growing. So that's the second part of life insurance. And the third part is, of course, is the death benefit. So you can notice that you put the money in, you get cash value, you get a death benefit. So if you deposit $100,000 in a balanced mutual fund, and at the end of the year it's gone up, that's what your balance is minus the taxation that you owe. $100,000 in a life insurance policy, you've got the cash value, and then if you did pass away, you've got $1.8 million worth of death benefit. So it's a completely different investment strategy. One that I love, the fact that you can invest and have this backdoor huge amount of money that your beneficiaries are going to receive because you chose this strategy. Okay, now let's look at it another way. If you were to make your deposits, $100,000, what do you notice what happens after the 7th year and you stop paying? The cash value continues to grow year over year. That was back to that chart where you saw the green bar chart and the money going up. You're not putting any more money in this. If somebody started at age 50, you can see now they're 65, they have $1 million in cash, but they only put $700,000 in. And no matter what they do, well, not quite no matter what, if they actually withdraw cash, that's going to slow down the compounding. But you can notice that the cash value is going up and up and up each year, despite the fact that you're not doing anything. There's no volatility you have to worry about. You don't have to worry about doing reviews. What do we do next? What should we change? None of that. It's the dividend that's coming in and the growth of your policy. Now, how do you get the money out? Everybody asks this question. How do I get the money out? First of all, I want to make this very clear, and that is you are not borrowing against the death benefit. I'll say that again. You are not borrowing against the death benefit. Some people have been confused about that, or they've heard that somewhere else, and it's just not true. The mere fact that your death benefit pays off the loan balance, that's true, but you're not borrowing instantly, $1.7, $1.8 million. It's not the case at all. So let's look at this. You have put your money in, and you are now 65 years old, and you decided, I want to take money out of this policy, and you say, I want to treat it like in the example that we just did, where I'm 65, I'd like to use this money to supplement my lifestyle. And you go to the bank and say, look, I've got $1 million. The same way a real estate agent or real estate investor would collateralize the equity in the bank or equity in their properties and take it to a bank and get a mortgage. Here you're doing the same thing. You've got $1 million in cash, and the bank says, well, if you want to have, working with an advisor, we work out this for you, but that works out to that we're going to give you $83,000 a loan, a line of credit, each year if you want to do it that way. If you wanted to, you could have borrowed $90,000 of your cash value right away. In fact, all that cash value is you're able to access anytime you want, year one all the way through the rest of your life. It's not disappeared, it hasn't gone anywhere. But what you don't want to do is you don't want to do physical withdrawals, right? Because you're slowing down the compounding of the ability for your cash value to grow higher and higher and higher. You actually just want to leave it alone, let it compound while you're borrowing the money. Does that make sense? Watch what happens. Year one, $83,000 you take out. Year two, you go back to the bank and you go, well, my cash value has gone up a little bit and give me $83,000 more. Year three, you do the same thing. You just keep going year over year, getting, and that loan gets added to the balance that you have. So make this clear. You're not making any interest payments on this at all, right? If you want to, you might be because you are a real estate investor, you took that money, put it into a house, now you want the deductibility of that loan. But if you're just that couple and you want to enhance your lifestyle, then you say, I don't want to make any loan payments, just let the balance go, and I'm going to just worry about the death benefit, they'll take care of that. In fact, let's look at that. At age 85, I'm now showing you, you've now got $2.4 million, that's the on the left, $2.4 million of cash value, and you took your final $83,000 loan, and you passed away at age 85. Let's use that as an example, okay? So what does that mean for you? Well, you have an accumulated loan balance of we'll call it almost $2.2 million. But you also have a death benefit of $3.2 million. So about $917,000, almost $1 million, goes to your beneficiaries tax-free. So think about that. If you are an individual, you just took the money out of the insurance, never paid any of it back, not a penny back from you personally, you just let the death benefit pay it off. That's where people get confused and they say, well, you're just borrowing the death benefit. Not quite, because in the beginning you weren't saying, I'm going to deposit $100,000 and give me $1.7 million. It doesn't work like that, right? So in this case, though, at the end of your days, whatever timeline that is, the death benefit will pay off the loan and the rest of the money will go to your beneficiaries, charities, whatever you need it to do. If you're a business owner, wow, the bells are going off in your head, right? You took corporate dollars that you were taxed on, and you take that and you're going to basically move it sideways into a life insurance policy under you're the insured person. You're going to take loans personally, right? Receive the money personally and not pay any income tax on that. That's a pretty powerful way to get rid of Revenue Canada, I think. Tell me another way for you to take money out of your corporation without paying any income tax. I'd love to see that in the comments. Okay, now last thing that I'll leave you with, and that is, look at the year-over-year growth of this policy. This is age 84 to age 85. Is $120,000 that this policy has grown by in 1 year, and yet you only took the $83,000 as a loan. Your policy is actually growing. Your cash value is growing well ahead of what you're borrowing. So this can continue to go on if you wanted to go well past age 85. If you're that real estate investor and you want to get this rental property, well, your cash is sitting right there in the policy. It hasn't disappeared. Any timeline, from year one to wherever, you can go in there and get the money and put that down on the next rental property if you want to. So you have, in essence, bought an asset, and this is an income-producing asset that you're going to collateralize at any point in your life. And remember, poor people buy expenses and wealthy people buy income-producing assets that they borrow against and receive tax-free income. That whole video message, the whole discussion that we hear in politics right now of taxing the rich and on their income, they go, we don't have income. We do stuff like this every day that we don't have income. This is just tax-free money to us. This is what you're doing. This is a real live example of how you actually do that. Now, what I like about this is that your life insurance has no tenants, it has no maintenance, and it pays out tax-free cash to you. That's the difference between doing this and a rental property, right? Now, to summarize, you deposited $700,000 in this example, and you received almost $1.8 million tax-free over your lifetime. Show me an example of how you could get this kind of investment that it has no other attachments like tenants, paying property taxes, paying maintenance, having to always worry about the upkeep or trying to get your rental properties all completely filled and tenanted all the time. I'm not saying real estate's a bad investment, because it's not. It's just a different investment that requires very little maintenance of your time and your effort. It's just really depositing money and watching this happen. So it's a very hands-off way for you to invest the money that you weren't going to spend, that you could have been taxed on pretty heavily by Revenue Canada, but you've managed to create an income stream and enhance your estate value as well. That is a powerful investment, one that is difficult to compare anything to. Okay, so that's the end of the presentation. What I want to share with you now is what are the next steps. What is different about this whole webinar is that there's nothing for sale. I'm giving you the entire strategy. There's nothing where it says you've got to make an appointment with me so you can find out the real way to do this. I gave you the full strategy. It's what I do, it's how I work. All my videos, over I think 100 videos on YouTube, speak to the same way. I gave you the entire strategy without having to reach out to me and say, okay, you got my attention. What else do I need to do? I'm giving you this free of charge, letting you know exactly how to do that. So if that's something that is of interest to you and you wanted to learn more about it, that's how we would begin the conversation, is saying, okay, what do we need to do? So what you need to do next is you need to click on the link below that takes you to my online calendar, and it's pretty simple, straightforward. I want to thank you so much for enduring this time today. It was a useful time, I think, for you to understand exactly what this strategy can do for you. I really look forward to hearing from you. I look forward to seeing your comments. I will reply to everybody that has put their information in there, and you have a question, I'll reply to you just as soon as we can. Thanks so much for going and registering, and I look forward to either meeting you on a one-on-one call. But again, thanks for your time. Take care.